It's hard to believe, but we're already up to chapter 20. After this, we have chapter 21, which is a revisit of the cash flow. And then I believe we are nearly done with our semester. So in this chapter, we're going to talk about changes. That is to say, if you make changes or have to make changes in your financials, or do you go back and do you change them for prior years? Or do you just go forward from the point you're at? If you go back and redo your financials from previous years, anytime you refer to those financials or you show those financials with your current year financials, you have to put a caption at the top, and the caption says restated. So if you were, say, in 2022, and in 2022 you were publishing your income statement, and you were a publicly traded company, and in 2022 you changed from, say, an acceptable practice under GAAP to another acceptable practice under GAAP, because various times GAAP gives us choices. Well, if you do that, some of the rules in this chapter are going to say you have to go back and restate. So when you publish your financial statements in 2022 and you're publishing your income statement, in 2022 you're going to be under the new principle and you're going to have your financials published that way, and so there's no need to say you're restating it, because in 2022 you're doing them a particular way. However, in 2021 and 2020, if you are required to go back and restate those financials, when you show the 3 years of income statement in your financials, you need to say at the top of 2021 column, you're going to say restated. And under the 2020 column, you're going to say restated, because those numbers you're going to show in the income statement for 2021 and for 2020 have been changed. They've been changed as if you had that accounting principle that you now have in 2022 in place in those previous years. So you're going to change them. You're going to show different net income. And when you change them, you have to make the caption show that they have changed, so that the reader isn't going to go back and look at the 2021 income statement and say, hey, in 2021 income statement didn't look the same as it does when you're showing it in the 2022 financials. Well, that explains it. So of course there's going to be a lot of disclosure notes and all of that whenever you change. And so we're going to talk about that. We're going to also talk about errors, because when you have errors, you also may have to go back and correct. One of the provisions I think you need to understand here is that if you're an accountant and you make an error and it's not a material error, you don't go back and restate financials. If it's a minor thing, and I'm going to say a minor thing can be, hundreds of thousands, and to you, you're going to say, wait, when I take my classes, if I make $100,000 error on an exam, the teacher doesn't say that's okay. But when you're in practice and you make $100,000 error, and this is not, this is a cumulative effect, say it's 100,000, you're a multinational corporation, it may not be material. And if it's not material, you don't go back and change your financials. Now, should you change your practices? Yes, you should change your practices. Do you want to make a catch-up entry in the next year? Yeah, you might want to do that. So in this chapter, when we start talking about errors, the assumption here is that the error is a material nature, and a material nature means that the readers of the financial statements are going to be come to different conclusions or make different decisions if you had not done this error. So for big corporations, it's usually millions. In our examples in class, they won't be millions. They won't be large numbers. And it may be a bit confusing to you. So I would say what they aren't teaching you in this class is that when you talk about in the textbook, when it discusses this chapter, I should say, in this chapter discussion about materiality, and materiality does become important when we're talking about errors. So accountants are not perfect. Sometimes we make mistakes. Sometimes we calculate our journal entries and then we record the dollar amounts wrong, or sometimes we put them in the wrong account, because putting things in a wrong account can also be a material error. Might not have a material effect on, say, the income statement net income, but it has an effect, say, between operating or discontinued operations or something like that, and therefore it could turn out being material. So materiality, when we talk about changes, are we talking about errors here with the materiality? You also have to not think of it just as, say, 5% of assets or 5% of net income. You also have to think about the decision-making process that the typical investor or creditor who's reading the statements are going to take from them. And sometimes another thing we do is we misapply the accounting standards, or we don't fully understand what we need to be doing. So this chapter is about mistakes. It's also about voluntarily changing from one acceptable method to another method. And it's talking about changes that happen within a company that cause us to change the way we do our accounting. It covers quite a lot when you think of it from that perspective, but it is not a particularly difficult chapter. If the business changes, say we are a part of a big corporation and we find ourselves as a separate entity because we have the corporation has decided to divest of this particular unit. What do we do? Well, the problem with this one is that there are going to be comparable financial statements that are going to go back in time, and the investor's going to look at those. And if you have a different composition of the entity from one period of time to the other, then the investor can't make comparisons. Therefore, you need to make it consistent so that the reader of the financial statements can understand it. And again, if it's not material, it would have it be shown differently than the other. What if you have a method of accounting for inventory and it doesn't seem to match what the natural flow of your inventory is? You know that when you're choosing between methods, one of the things you should do is you should consider whether it is a method that reflects your actual business. So it would be doing the right thing, wouldn't it, to change from one method to another if it can be justified? So these are things that we are going to be talking about. When you're the first one, a part of a larger corporation, and you change the composition of that corporation, or you're no longer a part of that corporation, these are things which you'll address and you'll understand a little better when you're in advanced accounting, which is the next class. So if you don't understand it at this point, I just want you to understand the basics of what we're talking about and how it's handled, and that's called a change of entity. So there are three types of accounting changes that we'll go through and how to handle each one. And then, of course, since this is intermediate 2, you have exceptions to the rules. And then you have errors. And again, on 4, when you're talking about errors, we are generally talking about material errors to financial statements, big problems. So here is the summary, which I said before is very helpful because it talks about here, if you notice the method of accounting across the top, it says retrospective and prospective. A retrospective change means going back to the past and changing what you have. I've been referring to that as restatements. When you do this, you have to pretend as if you have been doing things the way you are currently doing them for all the periods in which you're showing your financials. So if you're going to show balance sheet from previous years, that balance sheet from the previous years needs to be changed. If the income statement is shown, it's changed. If the cash flow statement is shown, it's changed. If the walk forward of equity is shown, it's changed. And there's big disclosure notes with all of this, goes without saying. So if you're changing from one acceptable accounting principle, it doesn't say that up there, but it has to be acceptable. This is not an error. It's changing from one acceptable accounting principle to another. In general, what you need to do is go back, restate, reshow the financial statements. Now, what happens though because you have retained earnings, which accumulates net income? Well, the earliest period of time needs to show an adjustment. So the beginning retained earnings balance will be changed, and then of course net income is likely will be changed for the periods of times disclosed. And you need to do a journal entry to formally change the balance in retained earnings. There'll be a time at which you are making these changes. It may be through the year, in which case your books have not been closed. It may be at the after the end of the year, beginning the start of a new year. And so when you do your journal entries, you have to pay attention into when you're making this election or when you're changing. So generally, I'd say if you had a choice of changing in your accounting principle, and this is what companies do, you would end your fiscal year and then start the new year under the new principle. Doesn't matter whether you do it within the year or you are starting a new year, you always are going to go back and do the retrospective adjustment. Now, having said that, there are exceptions. There are exceptions. And the exception to changing from one accounting principle to another acceptable accounting principle, they're both acceptable, is when you change to LIFO in the inventory method. So you're changing from, say, FIFO to LIFO. It is impractical to go back from the beginning to make changes. And whenever it is impractical to change to LIFO or other ones that may be mandated, changes that are changes to GAAP that we have a new standard coming out or something. When the standard says you don't have to do it, then you don't have to do it, and that's an exception, just like the to LIFO. So just memorize to LIFO, okay? Under changes in estimate, including depreciation changes. This is another exception. So if you have a change from one acceptable accounting principle and it deals with depreciation or amortization, you are going to handle those as if you are going forth. That is to say, you're not going to go back and change your accumulated depreciation account, which is a balance sheet account. So you're not going to change your balance sheets. You're not going to change your income statements. Instead, it's called prospective, and you get to go forth. So if you were to change from some of the year's digits to straight line, because straight line seems to be something that companies tend to use, and you weren't using the thing that most of your peers, your other companies in your particular industry were using, so you're going to change to straight line. You don't have to go back and redo all your financial statements. Instead, there'll be a lot of disclosure of this, but you're going to go forward, and you're going to go forward, and you're going to now start depreciation under straight line. So see what your balance is, see what needs to be taken off the books in a certain amount of time, and include your salvage value in your calculation. Just go forward. Now, what if another depreciation change then that you can have? This is not a change in principles, but a change, say, in the estimate. You change your salvage value. You change the life of the asset. What do? Well, you had this in Accounting 201. We didn't go back and redo the financials. You just go forward, and that's perspective. So perspective means go forth. Retrospective means go back. Notice again, across the very bottom, what do? You have to disclose. So you have to disclose the effect on earnings. You have to talk about why you're making the change. It's discussed. A change in reporting entity. This relates back to what I was saying in advanced accounting. You have consolidations and you have groups of smaller companies included under the umbrella of one. And a common example, I guess students may have had some application to, is to think about an industry like Koch Industries. It's a conglomerate really of companies, or to think about Leggett and Platt over there in Carthage, Missouri, and how they are a group of companies. But also restaurants. There's a lot of restaurants that fall under the umbrella. Even though the chains have separate names, they are really one big restaurant company. Well, if a company like this decides to get rid of one of their industries or one of their companies, then when the financials are put out, they are not comparable. They're not consistent between accounting periods. So you go back and you have to show what it would have been like if that particular entity had not been a part of your consolidation. Or on the other hand, if you're adding something, you're adding it to it. This change in reporting entity, I would say also, if we're talking along these lines about going from equity to another method of accounting for investments or accounting in consolidations, it's considered an exception. So as I said before, we have a lot of exceptions, and that is another one. So you have to memorize to LIFO and from equity. These are exceptions. They are exceptions to the retrospective method. If you make an error, again, it probably should say material error. You need to go back and correct. Now, there obviously is a point in time at which your numbers are not really showing up as in retained earnings. We only do the retained earnings statement back so many years, and when we show it, we show beginning retained earnings and we do a walk forward. That beginning retained earnings needs to be adjusted. So as it says here, adjustment needs to be made to retained earnings as of the earliest year reported when we do our financial statements. Again, disclosure. So while we're talking about errors, here's the deal with errors. If you have an error in your financial statements and it's related to revenue, and that is an income statement item, it has a dramatic effect on the stock market, because it is viewed by an investor as having an effect on the credibility of the financial statements. So we have to handle errors and disclosure of errors very carefully. Since it will affect stock price, it needs to be disclosed to everyone at the same time, which means, according to the SEC, you're going to have a disclosure, you're going to have a filing, which is put out there so that everyone can see it. And as I said, it will have a dramatic effect on the stock price. Now, what you would want to do with these error corrections is you would want to increase your credibility by disclosing, being truthful, by being transparent, and you would also want to maybe say that you're bringing in a separate auditing firm, separate from your normal auditor, to help you with it. Because you, again, want to be transparent, you want to appear to be very truthful, you want to be open to investors, and this will minimize the effect that it will have on your income statement. Generally, when we're talking about revenue adjustments, we're talking about adjusting downward. So the error is a downward movement. And this is an area where there could be fraud, and so the investment community builds into it the likelihood that there is fraud occurring within the financial statements. And that's why it tends to have a very dramatic effect on stock price. So it has to be handled carefully, discreetly, and with transparency. The accounting changes then are a change in principal, a change in estimate, and a change in entity. Those are the three ways of categorizing it that you see within the Spiceland book. So, a change in accounting principle is a change from one generally accepted to another. So, it has to be a change that is accepted. And so here they have an example of it, a change to equity method. A change to equity method is not one that meets the exception. You have to memorize it's from equity. From equity is an exception. A change in an accounting estimate. Here they say change in depreciation method. A change in depreciation method is actually a change in accounting principle from one depreciation method that's acceptable to another method that's acceptable. When you have this, you are going to treat it, this is an exception, as if it were a change in accounting estimate. That means with these changes in accounting estimates, you're going forward. Now, usually when we have a change in accounting estimate and this estimate affects us in future periods of time, like with depreciation, for example, we change our salvage value or the life of the asset, you will spread the difference over future time periods. So you figure out how much you need to remove from the books, and you're going to figure how many time periods you have to remove it and go forth, right? And so it's kind of spread over the next periods of time. You learned when we were in our compensation chapter and we were creating paid-in capital that when we change our estimates there, the emphasis is not on spreading the amount over the future income statement periods equally, say, but in looking at our equity account and trying to get our paid-in capital account to its proper balance, right? So I think some of the problems said 2/3 of, say, compensation expense needs to be on the book by such and such a date. 3/4 needs to be on by such and such a date. And that's the way we work the problem. But irregardless of that, or regardless, I should say, of that, this is a change in accounting estimate, which means you go forth. Now, changes in reporting entity are examples when you go back in time and you need to go back and you need to restate and show how it would have been if your current composition of your consolidation had been in existence previously. So it really looks like a what if then, right? But you have to go back and do this. It's not as difficult to do as you might assume because you would have the separate financials for all the entities and you would be able to determine what that is. So this is a change in reporting entity. So generally, the first one and the third one here are going to require us to go back in time, and we say that's retrospective and restatement. And the second one is generally going to be a going forth or prospective change, which you don't have to restate. And again, you have to know these exceptions. The exceptions become important. Changes. Okay. Changes in that are from errors or accounting changes then. Just to review what we just talked about. If you have to go back and state the past, restate the past, and as I said earlier, you have to clearly put at the top of those financial statements whenever they are shown that they are restated. When you do this, make them appear as if the newly adopted accounting method had been applied all along and or that the error had never ever occurred. And to get to this point, you have to do an adjustment. If it is something which involves, now typically all of these will have income statement accounts and balance sheet accounts. And in addition, one of those balance sheet accounts, if it is for previous years, going back more than just changing in our current year, and you have to do a retrospective approach, you will adjust retained earnings. Now, prospective approach means you'll do current and future years with this change. So the future years financials have never been issued. You don't have to restate anything because they've never been done. You're just going to go forward and you're going to use this new accounting method, or you're going to do the journal entries properly and not, of course, have errors in them. So there's nothing to do but just to go forth in the proper way. The current period of time, now this really depends on changing your financials and or how to handle that. So if you are changing to a new method that is acceptable and you are in between time periods again, so I'm going to go back and talk about the retrospective a bit. If you're in between time periods, and you're showing your quarters of this year, you actually need to go back and show those quarters for adjusted as well. Prospective, again, the current and future periods of time you will use your new methodology on. There's no need to go back and make a change. Most voluntary changes in accounting principles, you do have to go back and you do have to show all the financials, including a cumulative change in your retained earnings going back in time. So this is using LIFO, so it's from LIFO to FIFO. And this is not an exception. If it had been to LIFO, and not to FIFO, this would have been an exception, and you would not have had to go back and make changes. So they went back and they calculated the effects that would have been had they had this FIFO method in place for all their years of operation. Can you imagine the work involved here? But you got to go back and do it. And so the net income statement effect would be the changes in the cost of goods sold amounts under LIFO versus FIFO for each one of these years, and then also for previous years. So if they're doing their financials and they're showing 3 financials, they would then need to change and say at the top of 2015 it's been restated, 2014 restated. And since there is a cumulative effect for all the previous years of 300, you're going to see a retained earnings statement that's going to show the beginning balance as being affected by that income statement effect for all the previous years, say, I guess, through 2013. So the revenues and operating expenses that they have there for those years are given, and cost of goods sold is not a part of operating expenses, by the way. This is considered to be all the other expenses, I guess, of the company. The other thing we didn't talk about is the taxes, because it will also affect taxes. Now, you can see how, because you know all this about deferred taxes now, how that it gets a little complicated, right? So I'm not going to get into all that, but those of you who have your cogs spinning, you're seeing, oh, I see how this could affect even deferred taxes. And so, yes, any change or any error correction can have a tax effect. And the effect, though, for us that we're considering in this chapter is that if you pay taxes, the tax rate will affect the income taxes, and income tax expense is what they're getting at in this chapter. Ignoring deferred tax accounts, it will have an income statement effect. So what you need to do is revise your financial statements and you're going to go back and you're going to plug in now the FIFO number as if FIFO had been there forever. What they neglected to do, what did they neglect to do that I keep telling you about here, is in 2015 and 2014 they should have had restated. Because in 2016 they are going to use FIFO from the very beginning of the year, and as I said previously, that really is a preferred approach. You would not want to change it in the middle. It makes your life confusing and complicated, and you have to go back and restate quarters. And let us just start, between our fiscal years, or say January 1st, assuming December 31st fiscal year in, start on January 1st of 2016 and use your FIFO. It makes our life so much easier. That's what this company did. So cost of goods sold for the entire year under FIFO, which is what they did when they did their financials and did their journal entries, is 370. 2015 and 2014, you're plugging in the numbers that are the calculations that you say it would have been had you used FIFO for the entirety of those years. And because it's an income statement, you go down and you plug in your income tax expense, which is a simple way of looking at it as 40%. Then you know that your net income changes. So they make the statements appear as if the accounting method had been applied all along. They're drawing an arrow up or there to 2016's, but I'm not sure. I think we started in 2016. So when we go through this, you're going to have to revise your net income. Remember, net income is going to be adjusted not just for cost of goods sold, but for the net tax effect on cost of goods sold. And you can go back to your revised income statements and look at the new numbers and just plug those in there. You have to know that in the beginning number, January 1st, 2014, you would need to adjust that from your balance sheet, your original walk forward, for the cumulative effect of the net income change. And that includes the tax effect. So the cumulative difference prior to 2016 is calculated, and you will have to do a journal entry so that your new ending January, your inventory number needs to be affected for the change that comes about. Now, if we had done this in the middle of the year, your inventory number would have adjusted not just for retained earnings, but it would have you would also have adjusted cost of goods sold for this year too. All right, think about this a minute. So we have closed our books though, and since we close the books and we start a new year, all of our inventory adjustment is just retained earnings. So it's the previous year's amounts that we need to put in there. And so we are going to start in 2016, and we are going to then record our inventory adjustments, assuming we have a perpetual. Most companies do. It would be inventory and cost of goods sold journal entries, and we'd be doing them properly. Here, cost of goods sold has already been closed into the income summary and then into retained earnings for all those years. And so at this point, you're only going to be crediting retained earnings. There's no adjustment needed to cost of goods sold. Again, because cost of goods sold for 2016, all that will be done under our new method. Okay? Now the income tax payable account is going to have to be adjusted because income tax is going to be changed. What I would say about this is that it's basically when they're talking about retained earnings, they have closed the income tax expense also into retained earnings. So that retained earnings net income number, it has it's net of tax. The net income numbers you say up there, should be net of tax. Disclosure notes: if you're going to change from one acceptable method to another acceptable method, you have to justify your change. You cannot go back and forth from one acceptable method to another and going back and forth, because if you did that, you would be manipulating earnings and trying to mislead the investors. So you have to stick to a method and justify the method, which means you really need to think about it, why you're doing it. And so here is a discussion of the disclosure, and it would have an effect on net income, so it would have an effect on earnings per share, so of course you need to show that as well. And it says, point out that comparative information has been revised. Well, that's a nice way of saying you're saying it's restated. And there's a disclosure note that says why it is restated. It is restated for this reason, the effect is this much, and in its justification. It's so in this problem, big merchandisers is changing from FIFO to weighted average. What is our exception? Our exception is to LIFO. So if you don't see to LIFO, then your assumption is you're going to have to go back to the previous time periods and change it. They want to know what the effect is going to be on inventory. Well, the effect on inventory is going to be dependent upon the effect on cost of goods sold, and that's affected by the income statement. And to get at that, we really need to know how the income statement is going to look under both methods. So that's why you really can't get to the number. You're going to say C. The likelihood that your amounts will be unaffected is very small. I just don't see that happening. It might be increased, it might be decreased. You might have increasing cost of goods sold for those previous years or decreases in cost of goods sold for the previous years. Of course, net of tax. Now, what if you can't go back? If you can't go back, then you're supposed to start at your newest time period in which you can physically do it. You can capably do it. So they're not asking you to spend millions of dollars to try to figure out what your financial statements would have looked like from the beginning of time, from the beginning of operations. They are going to ask you to do what's practical. What's going to happen here? Well, the auditors are going to come in, external auditors, and they're going to ask you about this change. And you're going to justify the change. That's the first thing you're going to have to do. And then you are going to, of course, show them how you came up with your numbers. And if you can't go back, you need to tell them why you can't go back. The auditors they audit many different companies similar to your company, and they're going to know if your justification makes sense, and they're going to know how far back feasibly you could do it. So it's going to be settled, and it'll probably be settled with your auditors. You would discuss this maybe before you actually make the change, to see what would be involved when you start thinking about making the change. And by the time you get to the audit and they're in there auditing your company, which they do on some work on an interim basis, you'll be in good standing. So you'll know how far back you can do it, and the auditors will accept that. The other thing that happens here is sometimes we have new standards that come into place. For example, leases. Remember leases, all those rules a lot of those changed recently. So they'll say, well, you need to handle this lease in this way. And you're going to say, well, this lease has been on our books for 20 years. I got to go back 20 years and look at all that and figure out all that. And so they'll say, since everyone is going to be affected by this, we're not going to ask everyone to go back forever. We're going to give you a date at which you need to go back and change from that date. And sometimes it is a forward date, and they're going to say you're going to change to this new method at this date. You're not going to go back and change anything in the past. So this is according to, say, new standards that are going in place. And basically, you just follow the gap, you follow the new rules that are in place. A change in accounting principle that usually should not be reported by revising, and I would say this is restatement, okay? The one which is the exception here, what did we say it is? To LIFO. So the only option here where I see to LIFO on is B, right? To LIFO. And I say the way to remember this is to life, to life. Okay, so it should be B. The prospective approach, changing depreciation, amortization, and depletion methods. Yeah, anything along these lines, this is where you are amortizing or depreciating. So I say amortization, depreciation. These things go forth. So if you're changing from straight line to accelerated, yes, it's a change from an acceptable principle to another acceptable principle. And generally with those, you have to go back and you have to change the past numbers, except, remember, to LIFO. This is another exception. You don't have to go back. You don't have to change. You just go forward. So anything with depreciation, straight line to DDB, DDB to straight line, any other accelerated type methods, sum of the year's digits, any of these changes, you are going to treat it exactly the same as if it were, say, a change in salvage value or a change in the number of years of useful life. You are just going to go forth. Are there disclosures? Yes, there are disclosures. Change in accounting estimate then is accounted for going forward, and the reasoning here is that everyone in good faith makes errors. Now, if you are going to try to call an error a change in estimate, again, you're going to be up against the auditors. They're going to say, you know, what do I want to say there? If you have a past history which suggests consistently 5% of your sales end up in returns, and you have a history which is established for your company that 5% of sales are returned, and you never calculated things including that estimate, that is an error. That is not a change in estimate, because you should have known that if you are going to have typically a 5% return of merchandise, you can't get away with overstating net income. So it has to be a valid error, okay? And you can make a mistake in your judgment, and that's fine. And you also are required to rely upon others for estimates. We had actuaries that we used. These things are acceptable because you are doing your best. You don't have a crystal ball. You're doing your best. If we make an estimate and we have an error in the way we did it, this is okay, but you can't just ignore GAAP and not do estimates. We might actually end up, as it says here, changing our estimates in the future. That is fine. The problem here is when you don't adjust, when you don't adapt. Here we have a company that switched from sum of your digits to straight line. And they go in and they figure out the useful life and the residual value, and they're just going to change at the beginning of the year. And as I said before, much better to start any change at the beginning of the year. And they are going to change the way that they handle their depreciation. Well, what you need to do, I'm not going to ask you to understand or redo what you already knew how to do perhaps in Accounting 201, is you just look at it and figure out what your undepreciated cost is. And this is 27 and it's in millions. And then you're going to figure out what's your residual value, and then you're going to figure out what you need to spread, and you're going to spread it over the remaining years. Okay? So you're going to take it out over the next period. Okay, here. Which of the following is not a change in accounting principle? Usually is not a change in accounting principle, usually accounted for by retrospectively revising prior statements. So this is one where you usually don't go back and change your financials. Well, the last three are talking about inventory methods. And what's our exception to restatements with inventory? I wanted to hear 2 LIFO. I hope you thought that at least, right? Okay, so B, C, and D are not 2 LIFO. Therefore, it must be A. And another reason it's A is because A is discussing depreciation. With any changes in accounting principle from one accepted depreciation method to another depreciation method, you do not go back and restate. You go forth. It is prospective. Therefore, our correct answer is yes, A. The prospective approach is required for what? This is going forth. When do you go forth? And which one would you go forth on? A change in estimate. Now, there are exceptions. When we change our accounting principle, we said it was 2 LIFO. We said it was also, I didn't have an example of this, from equity. And we also said another one is anything that involves depreciation, amortization, or depletion. And those are exceptions on C. In D, assumption I said in the beginning is that the error is material. If it's a material error, you do not get to do prospective. I'm sorry. You've got to restate, and there's a lot goes along with that. A change in reporting entity. Changes in reporting entity, we need to make it look like our current composition of companies is the same as we have had in the past, so we can make comparisons. Therefore, we are at B. I like this question. It lets us review. Here we have amortization problem. Oh boy, amortization. So amortization is one of those exceptions, is it not? So here it says, during 2016, they decided that the benefits would be received over 8 years rather than 20 years. This is a change in estimate. So when they originally started setting the thing up in 2013, they had an estimate of the legal life of it. Now they've realized that it has a different legal life. Well, they can't go back to 2013, and they shouldn't be expected to go back to 2013 and pretend they had a crystal ball. Because if we did this, you also have to think about the impracticality of all of this. So we are going to go forward with this. And 3 years amortization plus 1 year's amortization from that first year, and we get the balance here calculated. Changes from reporting one entity to another type of entity, and this comes about. You need a disclosure note. You need to recast. I like the way they say this. Recast all the previous periods as if the new reporting entity was in existence. And this is a what if because they didn't exist then. But as I said previously, all you got to do is go back and you have to look at the separate financials and compile those. So if an error correction is when you have a transaction that's recorded incorrectly, or maybe you don't even record it at all and you should have recorded it, you have to go back. This is a 10 materiality and retrospectively restate. And I just say you need to do a restatement. Now this means you have to go back to all your previous years you are showing, and if you aren't showing it, you are going to adjust your beginning balances in those balance sheet accounts, including the balance that's in retained earnings, because retained earnings is the one that accumulates. So I would say if it was an inventory adjustment change, your beginning inventory on your balance sheet would change, right? So usually you're going to see retained earnings, other balance sheet accounts change. You are also going to see income statement effects. Perspective. Generally with perspective methods, you want to try to get this change happening at the beginning of the year so you don't have a change from one method to another method in the beginning of the year and making everything confusing. And with either one of them, for that matter, you want to do that. And so with this one, you're going forward in all the future periods of time, and you're going to be applying it. The exceptions are given, and it talks about it here. So again, retro, go back, perspective, go forth. Perspective is the current and future periods of time. If you have an error, there's a 4-step method to correcting it. And you have a journal entry that you need to do. Typically, as I said before, it's going to involve retained earnings. It may involve other balance sheet accounts. Typically, it does. And typically, if you find your error in the middle of, say, a financial statement period before the books are closed, then you're going to have an income statement effect. Previous year's financials need to be restated, write restatement at the top of it. And if retained earnings is one of those accounts, when you do your walk forward of equity, which is a requirement, it says a statement of shareholders' equity. And you notice here what I said in the previous chapter, if it's only retained earnings, you're only going to show retained earnings. But if you do a statement of shareholders' equity and you do walk forwards of all those equity accounts, which I often see, that needs to be restated. And then a disclosure note has to talk about it. In addition to all of this on errors, what did I say? Has to be handled very carefully. There's SEC announcements, which are press releases, statements that go out, and you need to be very careful in how you handle it because it's going to have a stock market effect. What's a summary of all that then? Think about that journal entry. What are the accounts that are affected by this thing? And there is a tax effect, so the tax effect also, we don't get into it probably properly within this chapter. To do that, you'd have probably some adjustments to your deferred tax accounts. Change all the financials. That means anything in which you're disclosing for the past. And in the present, you need to make your present financials correct. If they've never been issued before, there's no restatement. If you have quarters in this year that you've done, they need to be restated, right? Change retained earnings from the earliest it is. That has an effect on your walk forward of stockholders' equity. And then there is that big disclosure note. And as I said down here, when you have errors, this is what people lose their jobs over, because this has such an effect on the stock market, and it just looks really bad for your company. What is following is not true about errors and error corrections. The one that's not true is the prospective one. You don't do it prospectively, you do restatements. This one had debited expense for the cost of an asset. All right, what you need to see in this one is it's not a change in acceptable depreciation to acceptable depreciation methods, because they never took depreciation on it. They debited to expense. So what is going to happen with this? Well, in 2013, if they're assuming it's a calendar fiscal year end, in 2013, they are going to have a problem because they hit the income statement for the total cost. And they should have only hit it for depreciation, right? And the other thing, though, is their financial statements need to be hit for depreciation in the subsequent years, right? So it is a timing issue about when it hit the financials. This has a significant effect on their financials, material effect on financials. You got to make an adjustment. And the adjustment is going to include changes to accumulated depreciation and retained earnings. There will probably be tax effects. So what they need to do here, though, you probably didn't have to even go through and look at this, is just calculate anything here, is if you realize that they failed to take depreciation expense, there would be a cumulative effect on accumulated depreciation, right? And so they need to increase accumulated depreciation, and that's the one that fits the bill there. So inventory, just a moment discussion on inventory. You have had it discussed before that inventory adjustments are self-correcting. Well, yeah, they're self-correcting because inventory goes off the books, right? But it doesn't mean that you don't have to go back and correct your financials for the previous period of time, because if you made an inventory adjustment problem here, they had $1 million in inventory that they forgot to have in an ending inventory count. Yeah, if they went in and did an adjustment to make their inventory the way they saw it, but they just happened to see it wrong. Anytime you change your inventory accounts in a material way, that affects the balance sheet. That affects the statement, that income statement through cost of goods sold, and of course net of tax effect. So yeah, it is self-correcting, but the problem with saying that is the individual income statement, the individual balance sheets are going to be wrong. The other thing when we're talking about materiality is all the financial ratios that go off of those, including gross margin, is going to be off. So yes, it self-corrects, but it goes further than that. There is also a modified retrospective approach, and I alluded to this a little bit before when we talked about the perspective and how that if there are changes, sometimes we change our standards. The GAAP has changed. We haven't done an error, but GAAP changes. Well, we are told through the AACSB, when these new principles come into effect, new pronouncements come into effect, they may tell us you only have to go back so many years. Or they may say, I want you to just go forth from this date. And if they only say go back so many years, this is called modified retrospective. Modified retrospective, because you're only going retro for so many years. And then they can also say, only apply the new standard in the current period and don't make any adjustments. In that case, it's a prospective. This at the bottom, apply the new standard only in the current period and then adjust the balance of retained earning at the beginning of the adoption period. Well, that's telling you how far back they want you to go. So these are this is terminology that's usually associated with new FASB standards or changes which are made.